Liquidity equals value. I've said this 1,000 times, and most people nod their heads like they understand it, but they don't. They really don't. Because if they did, half the garbage that gets funded in this market wouldn't exist. If people truly understood the difference between being rich and having money, between net worth on a spreadsheet and actual purchasing power, between looking wealthy and being able to deploy capital when opportunity knocks, we'd have a lot fewer broke millionaires and a lot more people who actually understand how wealth works. And I'm going to tell you something right now that's going to save some of you from making catastrophic mistakes. At the end of this, I'm going to reveal where I see the biggest trap right now, where people think they're building wealth but are actually just building illiquidity, and it's going to cost them everything when the market turns. But first, you need to understand the fundamental difference that separates people who survive cycles from people who get wiped out. Let me start with a story because this is how you learn. Back in the early 90s, I knew a guy, let's call him Mike. Mike was rich on paper. He owned office buildings all over the place, probably $200 million in assets at peak valuation. Everyone knew Mike. Mike drove the Bentley. Mike had the beach house. Mike sat at the best tables. Mike was rich, right? Wrong. Mike had assets. Mike didn't have money. When the real estate market collapsed in the early 90s, Mike couldn't make his debt service. The banks came calling. His buildings were worth maybe half of what he owed. And Mike, with all his wealth, couldn't write a check for $5 million to save his portfolio because everything he had was tied up in illiquid real estate that nobody wanted to buy at any price. Mike went bankrupt. Mike lost everything. Meanwhile, I was sitting on $30 million in cash waiting. I looked poor compared to Mike for years. I didn't have the big portfolio. I wasn't on the list, but when the distress hit, I had money, real money, liquid money, and I bought buildings for 30 cents on the dollar from banks that just wanted them off their books. That's the difference between being rich and having money. Being rich is a balance sheet concept. It's assets minus liabilities equals net worth. It's a number that looks impressive on a financial statement or a Forbes list. Having money is a cash flow concept. It's the ability to write a check tomorrow morning without selling anything, without asking anyone's permission, without triggering a taxable event or breaking a partnership agreement or violating a loan covenant. Having money is freedom. Being rich is often just leverage and hope. Here's what kills me about this current environment. We've had over a decade of essentially free money, zero interest rate policy, quantitative easing, money printing, all of it. And what did people do with it? They levered up. They bought assets with cheap debt. They built portfolios that look fantastic when you mark them to market in a rising tide. Everyone's a genius in a bull market. Everyone's rich. But how many of them actually have money? How many of them could survive 6 months without a distribution from their fund or a sale of a property or their stock options vesting? Almost none. They're rich on paper and broke in reality. Let me explain this another way because I want to make sure this penetrates. Imagine two people. Person A has $10 million in treasury bonds sitting in an account earning whatever they earn. Person B has $10 million of equity in a private company that's valued at $50 million based on the last funding round. Who's richer? Most people would say person B. They have the same equity stake, but in a much higher valued asset. Wrong answer. Person A has money. Person A can deploy that capital tomorrow into any opportunity that presents itself. Person A can survive any personal crisis, any market downturn, any unexpected expense. Person A sleeps well at night. Person B has a valuation. Person B has hope that someone will pay that valuation when they want to exit. Person B is trapped. If the market turns, if the company needs more capital, if there's a down round, if the exit takes 5 years longer than expected, person B is stuck. Person B is illiquid. Person B might be rich, but they don't have money. This gets to one of my core principles about investing. Asymmetric risk. I want investments where the downside is protected and the upside is unlimited. But you can't have that if you can't exit. Liquidity is what creates asymmetric risk because it gives you the option to cut losses before they become catastrophic. When I buy a building, I'm not just looking at the cap rate and the potential appreciation. I'm asking myself, if I'm wrong, how fast can I get out? What's the market for this asset? Are there natural buyers? Can I refinance if I need to? Can I sell pieces of it? Liquidity creates options. Options create asymmetry. Asymmetry creates wealth. Now let's talk about how this plays out in different asset classes, because this is where people really screw up. Public equities are liquid. You can sell them tomorrow. The price might not be what you want, but you can exit. That liquidity has value. It means you can reallocate capital quickly. It means you can cut your losers and let your winners run. It means you can raise cash when you need it without begging anyone. Private equity is illiquid. You commit your capital for 7, 10, 12 years. You have no control over when you get it back. The GP makes that decision. You might get a great return, but you've given up optionality. And that lack of liquidity should demand a premium. But in this market, with everyone chasing returns, private equity is often valued higher than public comparables. That makes no sense. You're paying more for less liquidity. That's not investing, that's speculation. Real estate can be either, depending on what you own and how you structure it. I've always preferred owning things that have natural liquidity. Apartments in major metros, industrial properties in logistics hubs, office buildings in gateway cities. Why? Because when I need to sell, there are buyers. There's always someone who wants that asset. Compare that to owning some specialized property in a tertiary market. Sure, it might have a great yield today, but when you need to exit, you're going to spend 2 years finding a buyer, and you're going to take a haircut because there's no competitive market for it. The yield difference doesn't compensate for the liquidity risk. It never does. And this brings me to something that's going to offend a lot of people. But it needs to be said, your primary residence is not an investment. It's consumption. It might appreciate, and that's great, but it's not liquid wealth. You have to live somewhere. If you sell it, you have to buy something else or rent. The transaction costs are enormous. The emotional attachment clouds your judgment. I've seen people turn down job opportunities, business opportunities, life opportunities because they didn't want to sell their house. That's not wealth, that's a prison. I'm not saying don't own your home. I'm saying don't confuse it with having money. Your home equity is not available capital. It's locked up until you die or downsize, and by then it's too late to deploy it into opportunities. Let me give you the brutal mathematics of liquidity. Let's say you have $1 million. You can put it in an S&P 500 index fund, liquid, diversified. You can access it tomorrow, or you can invest it in your buddy's startup that he swears is going to be the next big thing. Let's say, and this is generous, the startup actually succeeds. It 10x's. You've got 10 million on paper, fantastic, but you can't touch it. The company's still private. You're locked up. Might be years before liquidity. Meanwhile, the index fund compounds at 10% annually. After 10 years, it's worth 2.6 million. After 20 years, it's worth 6.7 million. And here's the key. You had access to it every single day of those 20 years. You could have deployed it into distressed opportunities in 2008. You could have bought oil at negative prices in 2020. You could have done whatever you wanted. The startup guy, still waiting for his exit, still rich on paper, still broke in reality. Now, I'm not saying never invest in illiquid assets. I've made fortunes in illiquid assets, but you have to structure your entire financial life around managing liquidity. You need different buckets. You need your operating capital, the money that pays your bills and funds your life. You need your opportunity capital, liquid money that can be deployed quickly when distress presents itself. And only then, only after those bases are covered, should you have your illiquid investments. The problem is most people do it backwards. They commit everything to illiquid assets because the promised returns are higher, and then they're stuck. They can't invest in the next opportunity. They can't weather a downturn. They can't take advantage of their own distress, let alone someone else's. Here's another brutal truth. Rich people go broke all the time. Having a high net worth doesn't protect you from bankruptcy if you can't service your obligations. I've seen it happen over and over. Guys worth $50 million on paper can't make a $3 million payment because everything's tied up. The banks don't care about your balance sheet. They care about cash flow. They care about whether you can write the check. And when you can't, all that paper wealth evaporates. The assets get sold in distress at massive discounts, and you're left with nothing. All because you confuse being rich with having money. This is why I've always been obsessed with free cash flow. Not EBITDA, not pro forma nonsense, not adjusted this or normalized that. Cash. Money that actually hits the bank account that you can actually spend. When I look at an investment, I want to know what's the cash on cash return? How long until I get my capital back? What's the distribution schedule? Because until the cash is in my account, it's not real. It's a promise, it's a hope, it's a model, and models are always wrong. Let me tell you about another trap I see everywhere right now. People who think they're diversified because they own different asset classes, but it's all illiquid. They've got private equity, they've got real estate syndications, they've got hedge funds with lockups, they've got their own business. Look at that portfolio and tell me how they raised $50,000 in 30 days without selling something at a loss or borrowing against it. They can't. They're completely illiquid across the board. That's not diversification, that's concentration of liquidity risk. When the market turns, and it always turns, they're going to get destroyed because they can't adapt. They can't move. They're frozen. And speaking of debt, let's address leverage, because this is where the rich versus money distinction becomes life or death. Leverage amplifies returns on the upside, but it demands cash on the downside. When you borrow money to buy an asset, you've created an obligation that doesn't care about your net worth. The bank wants their payment. If your asset isn't generating enough cash flow to cover the debt service, you have to come up with the difference. If you don't have money, actual liquid money, you're in default. I don't care if you're worth $100 million on paper. If you can't make the payment, you're in default. And once you're in default, the banks own you. They'll liquidate your assets at whatever price they can get, and you'll be lucky to walk away with anything. This is why I've always been conservative with leverage. Not because I'm scared of debt. I've used enormous amounts of debt in my career, but I've always maintained liquidity to cover the debt service through any reasonable downturn. I stress test everything. What if rents drop 20%? What if interest rates double? What if we have another 2008? Can I still make my payments? If the answer is no, I don't do the deal, or I structure it differently, or I put more equity in, because I'd rather make a lower return and sleep at night than have a higher return on paper and risk losing everything because I can't cover my obligations. Now, let me talk about something that really pisses me off. The way the financial media talks about wealth. They rank people by net worth. The Forbes list, the Bloomberg Billionaires Index, all of it. It's all balance sheet stuff. It's all illiquid valuations of companies and real estate and art collections and whatever else. And people see those lists and they think that's what wealth looks like. They think wealth is owning a bunch of appreciating assets. They're missing the entire point. The wealthiest people I know, the people who have real power, they maintain enormous liquidity. They have hundreds of millions, sometimes billions, in cash and liquid securities. Why? Because that's actual power. That's the ability to act. That's the ability to buy when everyone else is selling. That's the ability to survive when everyone else is dying. Warren Buffett gets this. Berkshire Hathaway always has tens of billions in cash. People criticize him for it. They say he's not putting capital to work. He's dragging down returns, blah, blah, blah. He doesn't care. He knows that cash is optionality. Cash is the ability to be greedy when others are fearful. Cash is how you make generational wealth. You wait for the distress and you deploy when assets are trading at replacement cost or below. You can't do that if all your money is tied up. Let me give you a current example of this dynamic that's going to blow up spectacularly. And this is the distortion I promised you at the beginning. Right now, you have an entire generation of rich people whose wealth is concentrated in a handful of tech stocks, or even worse, in a liquid equity compensation. They work at a big tech company. They've got stock options or RSUs worth $5, $10, $20 million. On paper, they're incredibly wealthy. They live in expensive houses. They send their kids to private schools. They have the lifestyle, but they don't have money. If they want to actually spend their wealth, they have to sell stock. And when they sell stock, they trigger capital gains taxes. So they borrow against it instead. They take margin loans, or they do securities-based lending. Now they've got leverage against an illiquid concentrated position in a volatile asset. What happens when tech corrects 20, 30, 40%? Margin calls, forced liquidation. They're selling into the downturn at the worst possible prices. The bank gets made whole, they lose everything. And it's not just individuals. Look at all these venture capital funds and private equity funds that have been raising money hand over fist for the past decade. They're sitting on hundreds of billions in dry powder that they have to deploy. But they also have portfolio companies that are valued at massive multiples based on the last funding round, or based on comparable public companies that might be trading at 50 times sales or some ridiculous number. When the market corrects, when interest rates normalize, when people start caring about actual profits instead of growth at any cost, those valuations are going to collapse. And all those LPs who thought they were rich because their quarterly statements showed 30% IRRs, they're going to realize they were just riding a bubble. They don't have money. They have illiquid positions in overvalued companies that can't exit and can't raise more capital and might not even survive. This is the grave I'm going to be dancing on. This is where the opportunity is going to be. Not in the assets themselves, but in the forced liquidations that are coming. When people who thought they were rich realize they don't have money, they're going to have to sell. And they're going to sell at distressed prices because they don't have a choice. That's when you want to have money. Real money, liquid money. That's when you can buy quality assets at absurd discounts because the seller is in pain and you're not. Here's what you need to do, and I'm going to be very specific about this because I want you to actually change your behavior. First, audit your liquidity, not your net worth, your liquidity. How much money can you access in 30 days without selling anything at a loss? If it's less than 6 months of expenses plus 6 months of debt service on everything you owe, you're in danger. You're not rich. You just have assets. Fix that immediately. Build your liquidity reserves before you make another investment. Second, stop chasing yield at the expense of liquidity. I don't care if some private credit fund is promising you 12%. If you can't get your money out for 5 years and the fund can suspend redemptions whenever they want, it's not worth it. The extra yield doesn't compensate for the loss of optionality. Take the 8% in liquid investments and sleep well. Third, understand that concentration is the enemy of liquidity. If 80% of your net worth is your business or your company stock or your rental properties in one market, you don't have liquidity. You have a bet. Maybe it pays off, maybe it doesn't, but you can't call it wealth until you can convert it to cash without destroying the value. Diversify, but more importantly, maintain liquid diversification. Fourth, treat your credit lines like they're sacred. When times are good and you don't need money, that's when banks want to lend to you. Get lines of credit, keep them open. Don't use them unless you have to. Those lines are your emergency liquidity. They're your bridge to surviving a downturn until you can liquidate assets on your terms instead of the market's terms. Fifth, and this is the hardest one for people to accept, sometimes the best investment is no investment. Sometimes the best thing you can do with your money is nothing. Just hold it. Wait. Be patient. Let opportunities come to you instead of chasing them. The market rewards patience more than it rewards action, but patience requires having money that you don't feel pressured to deploy. Let me close with this because I want to make sure you understand the stakes. The next downturn, whenever it comes, and it will come because cycles are inevitable, is going to separate the people who are rich from the people who have money. The people who are rich are going to panic. They're going to be forced to sell. They're going to take losses. They're going to learn the hard way that paper wealth isn't real wealth. The people who have money are going to get richer. They're going to buy the assets that the rich people are forced to sell. They're going to consolidate wealth. They're going to come out of the downturn stronger than they went in. Which group do you want to be in? Because you get to choose. You can chase high returns in illiquid assets and hope the market stays strong long enough for you to exit, or you can build actual wealth, liquid wealth, money that gives you freedom and optionality and power. You can be rich on paper, or you can have money. You can't have both unless you're very, very careful about how you structure your financial life. Stop following the crowd into illiquid assets just because the promised returns are higher. Stop confusing net worth with actual wealth. Stop thinking that because your portfolio statement shows big numbers that you're financially secure. Build liquidity, maintain cash, invest in assets you can exit. Understand that the ability to sell is more valuable than the potential to appreciate. Liquidity equals value. I've been saying it for 50 years, and it's never been more true than it is right now. If you want to learn how to think like someone who survives cycles instead of getting wiped out by them, if you want to understand how to build actual wealth instead of just impressive-looking balance sheets, hit that subscribe button and give this a like. And if you've got questions about your situation, about whether you're actually liquid or just rich on paper, leave them in the comments. I'll tell you the truth, even if it hurts, because the truth is what's going to save you from making the mistakes that everyone else is making right now. The difference between being rich and having money is the difference between surviving and thriving. Choose wisely.